Are you curious what you can get in a return inside an IUL? Well, we're going to get into that. We're going to talk about indexing strategies in an index universal life, look at different index features that are available and what the returns look like right now and how they work and so forth. So stay tuned. Hi, Aaron Andrew here. We're going to get into, again, looking at indexing, talking about index returns, how they work, what are the differences, and understanding how each account can benefit you and how they work in different markets and so forth. So let's get right into it. So here's a particular product. Every company that offers an IUL, an insurance company, will have different indexing strategies and features. This is just one as an example we're going to talk about today. We're going to show you the historical, what it looks like, and kind of give you a little bit of important information about how these things work. So let's start out with the S&P. Almost every company is going to offer what we call an annual point-to-point strategy with the S&P 500. So the S&P 500, everyone knows, of course, S&P 500, and you look at that and say, all right, how is it working? And by the way, this is explained more in detail inside the Laser Fund in Chapter 6. So in Chapter 6, I get into the details. My father, Doug Andrew, my brother Emron, and myself, Aaron, we get into the details in Chapter 6 about how this works in indexing. So if you want more information, go to laserfund.com, get the book, and you can read more in detail about how indexing works. But that's what we're going to be talking about right now. So every company always will have the S&P annual point-to-point. So that means, what is the S&P today when you get in, and what's the S&P exactly 1 year later? So point-to-point is what it's called. So you can see this one, current cap is 10%. And that cap used to be 9, then it went to 9.5, then it went to 10. So these caps can change. I want them to be able to change. Some people say, oh, I want that guaranteed when I get in. No, the insurance company needs to be able to move it because they're earning different returns on their investments in 5 years, 10 years, 20 years ago. So they need to be able to have moving parts because interest rates change. So in this product right here, a 10% cap, you can see the floor right now is 0. It's always 0, but the cap is 10 and that can change. And then basically, there's no what we call spread. We'll talk about that in a second on the next one. But yeah, guarantee of 0 to 10. So it's really simple. If the S&P is up 5%, you get 100%. That's the participation rate. You participate 100% in the S&P up to 10%. So let's look, I'm going to go right now, the recording of this video, we're going to talk about the S&P 500 and where we're at today. Now, this is pretty wild. As of today, a year ago to today, the S&P is up 34%. I mean, that's a lot. Okay, that's not very typical. But the market had been down the year before, and as it's come up, we're up 34%. So in an IUL, we're going to be capped at 10. But the previous year, when the market was down like 15, 20%, we got 0 to hero. We didn't lose any of our previous gains from the other years, and your gains are locked in every year. This is what's super cool. So you look at this, 2 years ago, we would have gotten 10, or 3 years ago, 10. Then it went down negative, we get 0, and you don't lose the 10 you earned the previous year. And then this year it's up 34, we get 10. All right, so really simple. You're gonna earn usually between 0 and 10 inside an S&P unless the market's in between 0 and 10. All right. Briefly, I'm going to talk about this one, the multi-index monthly average. That one averages the index every month, and it takes the Dow, the S&P, and the NASDAQ 100, takes all three, takes 50% of the highest, 30% of the second, and 20% of the third, and it blends those rates together and says, all right, that one has a cap of 12.25. So pretty cool there. And you can see over the last 30 years, historically, these would have been 7.2 about and 6.8. So pretty cool. Now this means, the 6.3 means that's the highest they can show by law. With the AG 49A guidelines, the laws, they can only show an illustration of 6.3 when they show you the insurance company's numbers, all right? Now let's talk about the next, I'm gonna skip one and come down to these two. These high cap accounts that I'm highlighting right now, these are the exact same accounts, but they have a higher cap. How is that? 19.5 and 12.75 instead of 12.25 and 10. So how is that possible? Well, the company charges a 1% fee. That fee's not going to the advisor or to the insurance company. The insurance company is using that money to buy more options and hedging to be able to afford a higher cap. So I don't have time to get into it today, But read chapter 6 of the book, and we explain how the insurance company is doing this with options and hedging, okay? Because your money goes into the general account portfolio of the insurance company, guarantees it in bonds and mortgages and things like that, very safe, secure places, and then they take the interest on those accounts, and they're able to afford these caps in the different accounts based upon the cost of the hedging and the options. So let's talk about the uncapped S&P 500. Okay, that one sounds cool. Uncapped S&P. No cap, guaranteed, 100% participation rate, and the spread rate is 8.75. What does that mean? That means that you take 8.75 off the top. So if the S&P only goes up 10, you take 8.75 off the top, you only get 1.25. Doesn't sound very good, does it? Okay. But on the big years, like right now, for example, let's go back to the S&P here, and the S&P is up how much? Just do this exactly how it is. 34.12 to be exact, 8.75 off of that, we'd be getting 25% return, 25.37 to be exact. So 25.37 is what we'd get in that one. So it's like, wow, this second one, we would have got 10 if we were in this over the past year. This one, we would have gotten 25%. But some years, of course, one will do better than the other. Historically, they're almost the exact same. 6.8% in the last 30 years versus 6.75. So a lot of times we'll get into this uncapped S&P after a crash. So like last year, market was down. You could say, hey, let's get into the uncapped accounts. Market could rebound and come back up, and we could see a good return. And it all depends on the date you get in. Most companies use like once a month. So this company uses the 15th of the month. So if you put money in, for example, on the 5th, it'll get linked to the market on the 15th for 1 year. So those are the traditional index account strategies. A lot of companies over the last few years have these newer, what's called volatility control index accounts. Most of those have been around since 2016, or some are like brand new, a year or two old. But these volatility control accounts are a lot different. We're going to talk about those in a minute. I'm going to skip the first two just for sake of time and talk about the high par ones. So we have this JP Morgan Mercury account and this BNP Paribas or Paribas Global H Factor. These two accounts have no cap, guaranteed floor is 0, no spread, and they have right now 200 or 250% participation rate. What does the participation rate mean again? That 250% means you participate 250% in the return of the index, all right? It's like, how are they doing this? How do you get more than the return of the index? Again, it's all with options and hedging, strategies. So basically, with this index, the volatility is a lot less. So let's just do a little bit of a lesson here. So if we look at the S&P, we know the S&P is all stock market. It's all over the place, right? It's all stocks. Well, if you've ever heard of the VIX index, this measures the volatility of the market, volatility of the S&P. It's around 13 right now. That means like 13% volatility. If we look over the past year, sometimes the volatility has been a lot higher in the S&P. So like it's been anywhere from up to 19, 20%. A year ago, the volatility was up in the 20, the VIX was up around 26%. Just really high volatility. So the S&P is volatile all over the place. And so it's more expensive with options and hedging with the S&P. These other accounts, I'm going to just pick on the BNP account. If we look at this one, how the index works is it moves. How much is allocated to equities and how much is allocated to bonds or cash, depending on volatility in the market. So right now, it's about 35% US stocks, Europe stocks, Japanese stocks, UK, and 2-year Treasury futures about 50%. So right there, in that mixture of the portfolio, the index, it moves daily how much is allocated. Most of these volatility control accounts work like that. So let's go up here. This account, check out this. So this is the stocks. The green is the 2-year or the 10-year Treasury futures. What happened with that line right there? What happened in March of 2020? Anybody remember? COVID hit and everyone panicked. I mean, if we go back to the VIX index, check this out. There it is. There is March of 2020. Volatility spiked. The market crashed. Everyone was like panicking. We didn't know what was going to happen. So much uncertainty in the markets. And so volatility spiked. So guess what happened with these other accounts? With these accounts, everything went to like no equities, all cash and 10-year treasury futures. And slowly, as the market got more stable again, more gets allocated to stocks. And then in 2022, if you remember, the market was pretty darn volatile, okay? It was more volatile. The market went down like 14, 15%, I think, 20%, depending on the date you look at that year, the S&P did. So, less in equities, more in like the bond component, let's say. So that's how these accounts kind of work. But so they're not going to always follow the S&P. You got to be careful with them because sometimes the S&P will perform and these accounts will not, just the way they're designed. But if you look at this, check this out. So last year, using December, and again, at the time of the recording of this video, in 2023, it was up 4%. Well, that's not very much. So 4%, well, 4 times, this one's at, 2.5. So we're at, of course, a 10% return. But let's look at right now. Right now, this index is up. I want you to check this out. It's pretty cool. Right there. I'm right on their website. 8.44%. So let's do the math with that one. 8.44 times 250%. We're at 21.1% return. So clients that are in that account today, because it has no cap, they're getting 21% return in this account in their IUL with no cap. Really cool. And again, back in like the fall of 2023, these accounts were still negative. They were zero, where the S&P was getting a return. So it just depends on the markets each year, why we kind of diversify between them. But look at some of the other years. This is pretty fun. Look at like 2017. You look at 2017, it was up 16.5. So 16.55, we would have earned, times that by, 2.5, 41.37%. 41% return. And if it's negative, like there's a negative 10 back in 2022, we get zeros to hero, we don't lose. So historically, that's why when you look at these historical, you can see that they're showing like 15%, or this JP Morgan one showing 14. And the thing is right now, this JP Morgan Mercury is about flat still from a year ago, the way it's designed. Where this one is up, 8.5% about. So we're getting like 21% in that one right now. So it just depends. Each account's a little different. So a lot of times we'll diversify and put some in the S&P, some in these accounts. And also you can get some high par accounts. So right here, high par select. We pay a 1% fee. So we can pay a 1% fee on that BNP account and we can get 300. That 1% is buying us a little more upside. So instead of 250%, we get 300% of the index for that 1% cost. Look at the back testing on that one, 18%. Now, these accounts have only been around for 2 years. So yes, they're brand new. They've done, not as good the first year. The second year, they're doing really good right now. And so back testing them, you can look at all the components and they can back test it to see what it would have done. So this data is real data, what it would have earned. But again, these accounts are newer. There's others that have been around. For example, if we go to this other one, this BlackRock Endura account has been around since 2016. That one this past year is up 5%. And that company gives you 200% of the index. So again, 5% times 200%, you would get a 10% return in that one currently, okay? And sometimes you'd get, higher, of course. So when we look at these volatility control accounts, they're pretty cool. There's some other ones here that came out recently. This one's pretty cool too. So this is another product that's very similar. You have the S&P. This has got a little lower cap of 9.75. But what I wanted to show you in this one is this one has a 2-year S&P. So with a 2-year S&P, now you got to wait 2 years to lock in your gains, but no cap and a 9% spread. So that one right there, if the market goes up, for example, like 30% in over 2 years, so 30% over 2 years, you subtract 9, you get 21% return. And so that one historically is about 8%. And again, we like to use those kind of accounts after like a market crash. Here is their volatility control accounts. So they've got this newer one, this Goldman Sachs account that has got a 260% participation rate, no cap, similar to that other BNP account. Historically though, backtesting it shows about 19%. Now the last 10 years, it's more like, I think 10 to 12. So going back further than that shows about 19. So I wouldn't bet on 19, of course, but it's pretty cool to see what it could have done historically in these accounts. They're really, really powerful the way these accounts are designed. There's also some 2-year accounts with these where you can get, 265, or there's a 2-year Goldman Sachs account that you get 370%. So if you're able to wait 2 years, you get 370% of what the index does with no cap. That one shows back testing of 25%, returns. Crazy. Tax-free with no risk, zero's the hero. All right. So basically, out of these different accounts, you've got, most companies will have a volatility control account, and S&P will mix and match, and we'll meet every year with our clients to say, which one should we be in this year? How should we mix up our percentage? You can go 25%, 25% here, 25% here, and 25% here. So you can mix it up within your product. And this is just a taste of one of them. There's lots of different companies and products. That's where we go through to see the integrity, the track record of the company, and really dig into those details to see which ones we should use, for our clients. But thank you for watching, and make sure you go to laserfund.com, get a copy of the book. For a nominal fee for shipping and handling, we get you the book for free. And chapter 6 is going to talk about these strategies. And in the book, I didn't talk about it today. There's some companies that have what's called multipliers, where we can multiply your return even higher with certain strategies. So make sure you get that, and you can read about it in the book in chapter 6. So thank you for watching.